I'm joined today by Dan Whitestone, who's the manager of BlackRock Throgmorton Trust, and we're going to be hearing a bit more about that trust and how it works. But first I thought we'd start by hearing from Dan about how he got into the job.
By a bit of luck, really. The plan was never to be a fund manager. I actually spent a year coaching football in the US straight after university and toyed the idea of becoming a teacher like my parents, but actually went and spent 4 years working strategy consultant, understanding how industries evolve, how they adapt, understanding strengths and weaknesses of various business models, and that got me thinking about industry analysis and basically investing in shares. And from that I moved into investment banking. I spent 9 years, once for a boutique, once for UBS, looking at and analysing in companies. And through that I was offered a job by my old boss, a great investment manager called Richard Plackett, who hired me to come and work for him, take over his funds. I've now been at BlackRock for about 11 years. I lead the emerging companies team and I am the lead manager for the BlackRock Throgmorton Investment Trust.
So the investment approach is focused on identifying differentiated growth companies. Why is that?
The way I think about it is really there's like two types of investment, but really they sort of like intersect in this Venn diagram. So it's never that one company fits in one box or the other box and nothing in between. I really believe that like the best investment opportunities, in my view, are those companies that can compound high organic growth rates through time, high operating margin. They can convert a high percentage of their profits into cash, and they can put those cash flows back into the business at high rates of return. And that way you sort of like are in this virtuous flywheel, you can beat the fade, and ultimately you can end up in a sort of an arc of like beats and raises, which are rarely captured in consensus forecasts, and therefore you can deliver a market capitalization that can multiply through time. And the first thing we always start with is trying to evaluate the strength of a management team. We want to actually understand like what the vision is. And more importantly, we want to understand like the breadth and depth of the management team around that, i.e. the people who are actually executing and delivering on strategy that's been outlined. Like if you're moving into a new country, new territory, new market, new product launch, etc. Because obviously many things can go wrong from vision in execution. So then we want to actually understand like what is so special about the product. We don't really want to own companies that sort of like compete on price. Price needs to be like not on the list or really way down the list. So for an industrial, it's around what solution are you providing, how are you solving that customer need, or how are you solving the need of a customer they don't even know they need that, have that need for. For consumer, it's about some product that people just really, really want, or it taps into the zeitgeist, and again, price is not the lever. And so things that we look for obviously are how you're investing in your business, how you're staying ahead of the competition, and that really speaks to like differentiation. And so there could be certain unique financial characteristics. Generally, they'd be afforded like high gross margins. It would reflect obviously their pricing power and the value they bring to their customers. Generally, they'd spend a decent percentage of their revenues on R&D. Generally, you'd see from their organic growth rates, particularly industrials, you'd see a high percentage of products coming from new product development. So you can see they're investing in their business, and that money's being spent wisely and is manifesting itself in better organic revenue growth. Then we sort of evaluate the actual market structure and the industry they're in. There are certain industries that we avoid, we generally don't like, particularly, there are some exceptions, but generally very capital intensive and cyclical industries. You know, generally have avoidance for basic materials, for resources, legacy telco, utilities, industries that are constantly impacted by regulation, industries that can be upended by irrational low-cost competition, could come from the Far East, different cost of capital, different reasons. And so if you can find, I think, like, it sounds obviously glib, but great product or a great management team in a fast-growing or secular-growing industry where you have a strong market position, either it's dominant or maybe you have a small market position, a very, very fragmented end market, but you have a superior mousetrap, like 4imprint comes to mind, a company that's been in the trust for over 10 years, then you can deliver very, very high rates of organic revenue growth, either through product development or particularly in 4imprint's case, through winning market share.
So why is it important to focus on quality when you're looking at small caps?
Quality, I accept, is a subjective term, but I guess there are some financial characteristics that I think underpin quality, and high organic revenue growth, high gross margins, high cash conversion, high return on invested capital, return on equity, maybe some of the things I'd point to. I guess maybe I passed it before, like I've always grown up to believe that anything can happen to an investment, and effectively it can halve at any moment in small mid caps, and I've always it's always been true to me. If you have a high gross margin, just mathematically, like much better place to start. Chances are you can still be profitable. If you're a low margin business, but you've got low gross margins and maybe you've got a lot of money going out in SG&A, sales and marketing, etc., or distribution, then if you have a problem with your revenue line, whether it's volume or price, that can work its way through your P&L in a very, very negative way very, very quickly. And therefore you can, if you're low margin, you literally can swing into a huge loss very quickly. And if you've got a balance sheet, or if you've got financial leverage as well, that's how you end up in a lot of trouble. If you're 2 times leverage and your profit's half, you're on 4 times leverage, chances are you breach your banking covenants, you're running around and your share count's going up. Not attractive.
Throgmorton Trust had a great run of performance recently. What's been driving that?
The stock specifics have become more meaningful as a driver of performance since certainly the first half or first 9 months of 2022, which is a difficult period for the trust has been documented, and is only my only down year, I think, in the 9+ years of running investment trusts. The most important thing really for me is like where we are in the cycle of small mid caps, and this isn't the question that you asked, but obviously one headwind, or a headwind to performance more broad, not for me, but for the asset class itself and for the peer group, has been the pervasive outflows that we've seen. And interestingly, and it could just be an anomaly, it could be the start of the trend, discuss, but May was the first month of an inflow in the sector into UK small and mid caps. That's after 35 consecutive months of outflows, which roughly is about $17 billion worth. That's a huge headwind. Now, my personal view is that is a moment in time, okay? And I think if you look at just the last 6 months that we're talking about for our, May marks a 6-month period for our financial year, the trust has delivered in NAV terms around over 19%, so 2.5% ahead of the benchmark, but that 16 or so benchmark return, that stands pretty comparable against the NASDAQ, which I think is about 17 and a bit over that same 6-month period, and of which around a third of that return in NASDAQ came from one share. Getting back to the question you asked, it's really about what do you think is driving performance, and it comes to stock specifics, but ultimately it has to be viewed in this context that actually the backdrop, I think, is getting better. Positioning is so extreme based on the flows I spoke about. So when you've got such low positioning, it's almost like there's nothing really left for these sellers to sell. Trading remains resilient, the economic outlook's getting better, and I think could actually really strengthen. There's definitely a credible scenario how it could really strengthen from here. Then we get to an election, which we'll probably talk about in due course. You put all these things together, that's quite a compelling backdrop. And that's no coincidence that M&A activity in the UK is going up. Other people see the value. It's a real shame that so many of our incumbents don't, but I think it's a moment in time, it will pass, and therefore I personally believe, and this is not measured in the next 3 months or 6 months, whenever this recording goes out, I personally believe that we are in the foothills, I think, of a new cycle, a new period, and I see no reason today versus history of why that outperformance or long-term outperformance of UK small mid-caps versus large cannot reassert itself.
You mentioned the election there, so what difference do you think that might make? Okay,
well, the first thing anyway, these views are my views, they're not BlackRock's views, they're not the board's views, so, and obviously I'm mindful of this comment might age badly when this video goes out, but look, the first thing I'd say is that I think we're in a far different place from the Corbyn-led Labour era of the last election cycle, which I definitely thought was a much bigger tail risk. If you look at the Labour manifesto, which I have done, it is to me, effectively a centrist political agenda. And when you drill into some of the details, if I was to take, for instance, housing, my view, or my team's view certainly, would be actually their proposals are probably the best of all the political parties that I've seen to date, and could be extremely beneficial for many positions in the fund. I've been buying house builders, I've been buying brick manufacturers, I've been buying RMI, supply related, because ultimately I think that this is the depressed year for volumes. Most of these companies trade on trough valuations, on trough volumes, and things will get a lot better from here. And I think the earnings recovery and also the margin progression, because for many of these reasons they've re-engineered their cost bases and have generated superior pricing power because so much capacity has left their industries, could actually mean that profits could be materially higher in absolute, but more importantly as a percentage of revenues in percentage terms in a new cycle. And I think that actually could lead to not only a re-rating evaluation, but actually significantly higher through the cycle re-rating in some specific cases. The other thing that comes out from all of our meetings with companies, okay, people want political stability. It's very hard to make long-term investment decisions as a consumer, certainly as a corporate, both domestic or internationally facing, when you've just got an absolute merry-go-round of cabinet ministers. I've forgotten the stats. Someone told me the other day, like how many different housing ministers we've had in the last 6 years. It's a big number. I don't see, famous last words, a Labour win as a big risk to the portfolio or to the UK economy. Questions will be asked about how it's going to be funded, and Treasury and politicians and economists will all argue about this. We know what they've ruled out. I can't speak for what other tax rises might come my way. But on face value, I think it's a pro-growth, pro-wealth political agenda, and a far cry from perhaps the Labour Party of old.
I mean, now the inflation's come right down to 2% now. What difference do you think an interest rate cut is going to make to the market?
Well, it all depends when it happens, when the interest rate comes, and what's the reason for it. Inflation has come down significantly in the UK, as we thought it would. However, I'll be the first to accept that you can see in today's inflation print, there's two ways to read it. One is, oh my God, it's 2%. That's happening a lot faster than we thought. And services are still to fall. Services is coming down, but it's still lagging, and hasn't come down as perhaps other people. Someone else might look at it and think, oh, it's 2%, but it's really because of the timing of energy dropping out, and services is stickier and hasn't fallen as much as you think. And so there are instantly today two different ways of reading the same thing. I get that. I still think that services, it does lag, and so being somewhat of in the glass half full, I do think that's to come. It doesn't mean, though, that the Bank of England will cut rates. I think they should, because the last thing you want to do is choke off this economic recovery that's coming through by acting too late. Again, this is a view expressed by myself, not by BlackRock, not by the board. But so therefore, done the right reasons, I think it'd be very positive. If you leave things too late and cut rates because you've got a growth problem, that's a different economic scenario, and I suspect the output or outcome on some of the shares in this fund could be different. So I think it's always important just to sort of frame what's driving the rate cut. But if we get into this world where people start to cut rates because they can see that actually inflation is back under control, obviously the one thing to think about is wage inflation. The thing is, wage inflation is always with a lag, reflecting the timing of base elements. So of course at the moment wage inflation can be running above headline inflation, but of course if you then roll that through, or you annualise that itself can come down. And just as an anecdote from many of our companies, obviously many of our views, forget individual market structures or consumer trends or industry trends, a lot of our macro views are often informed by many of the companies that we meet. That sort of bottom up, that mosaic theory. And a lot of our companies have told us quite clearly in recent interactions that they feel much better about the outlook for wage inflation. And so it's much less of a headwind to profits when we start to evaluate, risk to earnings. And actually, in many cases, it's coming in below original budget, which shows you that there is some easing that's happening right now through corporate PLC. But of course, there will be that lag from announced pay rises. You analyse that versus headline CPI. But it's obviously something that we will absolutely have to monitor.
There's been a few takeovers in the UK market recently. Do you think they're happening at fair prices? Are they things that Throgmorton holds and you've benefited from, or?
It's a bit like a roulette wheel with takeovers at the moment. It's cost me roughly 100 basis points of relative performance just in the last 6 months of companies in my benchmark being taken out that I don't own. 100 bips. I mean, that's quite a headwind. There have been 2 companies in the last 6 months I have owned. I've also had 2 shorts that have been bid for, which again has been a headwind to performance. So, one thing's for sure is the levels of M&A activity are elevated, and I think, obviously for the simple reason that the whole small mid-cap complex in aggregate, I think, is compelling value. Certainly in the 20 or so years I've been looking at shares. And unfortunately, as sort of over the last 20 months, been persistently ignored by so many traditional market participants. And so, unfortunately, therefore, private equity or corporates will effectively use that to their advantage. Which brings me then to your question around valuation. Again, it's a case-by-case basis. There are companies that I've owned, so I think, hang on, like this is outrageous in terms of like the price today versus the long-term opportunity cost of selling this today. And obviously there are companies I don't own, deliberately so, where I look at the bid price and think, you know, why are you paying that for this? So you're absolutely bailing out this company and these shareholders. So value is always in the eye of the beholder, and obviously I'm biased and someone else you interview will say the exact opposite, reversing my shares. So, but like taking a step back, people will always be opportunistic, and fair play to them. If the stock market doesn't want to reward great companies or affect a change that people are agitating for at the speed that they need, then someone else will do it for you. That's always been the case. But I think now you can effectively, in so many cases, use the company's own balance sheet to effectively leverage or finance your own deal. I mean, it's pretty compelling. I mean, you really can buy good quality companies at very, very cheap prices right now. And so the question for all of us is not to settle for a 30 to 40% cash premium when everyone's, depressed because the small mid-cap space is down over 2 years and bemoaning the perpetual low valuation that people are putting on all these shares and selling out for a quick bid, and actually stepping back and thinking, hang on, like what could this company do if actually just let it to like run its course in terms of organic earnings growth? You augment that with some front-footed acquisitions because you've got the balance sheet to do it, and you get the re-rating that takes you back anything like to your historic average, reflecting obviously high organic growth rates or versus your US peers. That upside sometimes can be really material.
This is a growth portfolio, but it's not all about technology. There's quite a lot of exposure there to consumer and industrials. So what's going on within the portfolio then that explains that?
Well, I guess one observation is that the UK doesn't have that much technology sector to focus on, and it gets smaller as each year goes by. Obviously, I'll be the first person to say that actually that technology manifests itself in different ways, and so there are many companies within consumer, and in some cases industrials and certainly financials, which technology ultimately is the underpin of what they do, and therefore, specific labels could be somewhat misleading. But you're absolutely right. Like over my 9+ years or so, like I've always generally been drawn to consumer and industrial. I just think they're exciting parts because, like, to me, industrial companies, by and large, are far more differentiated than just like what's IP. Consumer companies come down to much more than just what's consumer confidence, household cash flow, and GDP. These two areas comprise multiple different idiosyncratic companies, which in our own view, through time, 3 years, 5 years, 10 years cycles, can lead to huge different dispersion in financial results and, more importantly, share prices.
So thanks very much for that, Dan. I think we covered a lot of ground, and I found it quite useful, and I hope the viewers did too. So we'll get you back again another time, but in the meantime, good luck with it all. Yes. Thank you.
Good workout. Thanks, James. Enjoyed it. Thanks very much. Thank you.